Stephen Hagenbuckle, managing principal at TerraCap Parnters. Stephen is also a board member of the Fort Lauderdale-based Landmark Bank. Gentlemen, good to have you on the program. Welcome.
Thanks for having me on.
So, Charles, let's kick this off with you. Analyst Dick Bovee says he expects another 150 to 200 banks to fail in the current financial crisis. What do you think?
I think he may be light. I think we have a very serious debt problem in this country at every level. I think the consumer has borrowed too much, corporations have borrowed too much, banks have borrowed too much, and now we've learned from the federal government that their solution is that they want to indeed borrow even more. You don't solve a debt problem by borrowing more money. We need to get debt under control.
Do you agree with that, Stephen?
I certainly do, especially with the numbers on the banks that are exposed to fail. I feel that in the state of Florida alone, we're looking at probably 25 banks that will fail in the next year to year and a half.
Why? What is still the sticking point out there? And what are you characterizing as these failures? Are these small regional banks? Are they plain vanilla lending institutions, or do they have more exotic derivatives on their books, or what? Which ones specifically are going to fail in your view?
I think small community banks, and I also feel some of the smaller regional players will fail. Reason being, risky loans as well as risky investing. So a lot of their portfolios were weighted heavily with regards to the residential subprime loans and also the developer builder loans. And then when they had light loan potential, or they were in areas where they couldn't generate good loans, a lot of them are trying to offset earnings by investing in mortgage-backed securities, and we all know what happened there.
So is that what you're seeing as well, Stephen?
Sorry?
I'm just wondering if you're agreeing with the idea that it's the same situation and problem that we were faced with last September in terms of these failures. What is the underlying reason that you believe we are still going to see upset in the system?
Well, I think if you're asking me, Maria, I think that, you know, in the last 12 months, we've had extraordinary actions taken. And if you look at the financial results that have been posted by some of these banks, they're not that good. And for a lot of these companies, our survey of the Dow Jones 30, for example, looking at the 22 companies that report on a calendar basis, showed down revenues and down profits for a majority of them. So, you know, the underlying system is not yet back in a recovery phase. The government is, in our view, crushing private sector jobs. And we have this mountain of debt to deal with. We're going to all face the music when we come back from Labor Day, in our view. What
about the article today that we're going to see some foreign banks try to get in on some of this upset by, you know, acquiring companies that they feel are undervalued? Steve, you run a private equity fund and are excited about the opportunities here. Do you think that the FDIC should be relaxing the rules for private equity to buy troubled lenders? And then I want to ask you about the international part of it.
Yeah, absolutely. I think they need to lighten up themselves with regards to the rules and the regulations. I feel personally, as we manage a private equity fund, as long as there's real tangible assets behind it, it should go to the highest bidder. Right now, the highest bidder is anywhere from 30 to 50 cents on the dollar. If they're ready, willing, and able, they should be able to have access to those real tangible assets. The other thing I think that's somewhat at risk is if they don't, the only place that these banks are going to have capital to cover themselves is from their own shareholders or from their board members, because right now these banks, these community banks, are living off of their past profits. They need to move more money from their past profits into their loan loss reserves for those exposed assets, which I spoke of earlier, and that is the assets that are tied towards the subprime mortgages and the builder and developer loans, which represent about 25 to 30% of the loan portfolios of these smaller banks.
Charles, what about that? Do you agree with that we should see a relaxing of the rules?
Yes, I mean, I think, Maria, we're in a competition for scarce equity capital in this country, and we need to get it from wherever we can get it. In terms of letting private equity funds in, I think it's going to be important to let those funds in that have a long investment horizon. The idea that you're going to put money in for 18 months, I think, is short-sighted. I think we're in for a good 7 years, maybe 10 years of flat to down restructuring here to deal with the past sins.
Now, what about the international part of it? Spain's BBVA was the first successful foreign lender this past weekend to take over a failed U.S. bank, Guarantee Bank of Texas. Do you think foreigners are also going to come to the rescue here?
I would hope so. I think we really need to encourage that, assuming that these foreign banks are regulated in a way at least as strict as ours. The last thing we'd want to do is let a light touch regulated bank, play havoc with a system that's already in the operating room.
All right, gentlemen, thanks very much. We appreciate your time tonight.
Thanks for having us.
We'll see you soon.
Thank you.
Up next, is there an